Welcome back to the Mortgage Loan Originator Exam Prep Podcast. In this episode, we're diving into non-traditional mortgage products, which don't follow the typical fixed-rate loan structure. These products include adjustable rate mortgages, ARMs, reverse mortgages, interest-only loans, balloon mortgages, and HELOCs, home equity lines of credit. We'll break down how these loans work, their pros and cons, and important exam tips to help you master these concepts for the test. Let's get started. Part 1, Adjustable Rate Mortgages. An adjustable rate mortgage is a loan where the interest rate changes periodically based on a benchmark index plus a fixed margin. This makes ARMs more complex than fixed-rate loans. So let's break down the key components you need to know. ARM pricing components. Index plus margin equals interest rate. The borrower's interest rate on an ARM is calculated by adding the index to the margin. 1. Index. The index is a variable benchmark rate that changes with market conditions. Commonly used indexes include SOFR, Secured Overnight Financing Rate, Treasury yields. The index fluctuates over time, which causes the ARM's interest rate to adjust. 2. Margin. The margin is a fixed percentage added to the index to determine the borrower's interest rate. The margin never changes for the life of the loan. It's set by the lender based on the borrower's credit profile and loan terms. Think of the margin as the lender's profit margin. Quick example of index margin. Let's say the index is 2.5% and the margin is 2.25%. The borrower's interest rate would be index 2.5% plus margin 2.25% equals 4.75% interest rate. Caps, limiting rate, and payment changes. ARMs typically have caps that limit how much the interest rate or monthly payment can change at various points. There are 4 main caps. 1. Initial rate cap. Limits how much the interest rate can increase or decrease at the first adjustment date. 2. Periodic rate cap. Limits how much the interest rate can change up or down on any adjustment date after the first adjustment. For 3, lifetime rate cap. Limits how much the interest rate can increase over the entire life of the loan. This acts as a rate ceiling. 4, payment cap. Limits how much the monthly payment can increase on any adjustment date. Important, the payment cap does not limit the interest rate itself, only the required monthly payment. If the payment cap causes the borrower's payment to fall short of the interest owed, the unpaid interest is added to the principal balance, leading to negative amortization. Test tip: negative amortization and payment caps. The exam may ask about negative amortization, which occurs when a payment cap limits the borrower's monthly payment, but the interest owed continues to increase. This causes the loan balance to grow. For high-cost mortgages regulated by HEPA and qualified mortgages, QMs, negative amortization is prohibited. Pros of ARMs: lower initial interest rates compared to fixed-rate loans. Can be beneficial for borrowers who plan to sell or refinance before the first adjustment period ends. Cons of ARMs: payment shock. The borrower's monthly payment may increase significantly when the rate adjusts. Risk of negative amortization if the payment cap limits the borrower's payment too much. Up next, reverse mortgages. A reverse mortgage, also known as a home equity conversion mortgage, HECM, is a loan available to borrowers age 62 or older that allows them to access their home equity without making monthly mortgage payments. This type of loan is often used by retirees to supplement their income. Let's break down the key features of a reverse mortgage, including who qualifies, how it works, and the risks borrowers need to understand. Key features of a reverse mortgage. 1. Eligibility requirements. Borrowers must be 62 years or older to qualify. The home must be the borrower's primary residence. The borrower must stay current on property taxes, homeowner's insurance, and home maintenance. 2. Payment options. Borrowers can receive the funds as a lump sum, line of credit, or monthly payments. 3. Repayment terms. The loan is repaid when the borrower no longer lives in the home. This could happen if the borrower sells the home, relocates, or passes away. The loan balance grows over time due to accrued interest and mortgage insurance premiums. Heirs can sell the property or pay off the loan balance to keep the home. Pros of reverse mortgages: provides retirement income without requiring monthly mortgage payments, can help pay off existing debts or cover medical expenses. Non-recourse loan: the borrower or heirs will never owe more than the home's value. Cons of reverse mortgages: higher upfront costs compared to other loan products due to MIPS and closing costs. Reduces home equity over time. The borrower must stay in the home as their primary residence and stay current on taxes and insurance. Failure to do so could result in foreclosure. Risks to borrowers: 1. Loss of equity. Over time, the loan balance increases as interest accrues, reducing the homeowner's equity. 2. Foreclosure risk. If the borrower fails to pay property taxes or homeowner's insurance, they risk foreclosure. 3. Heirs must handle repayment. When the borrower passes away, heirs are responsible for repaying the loan, either by selling the property or paying off the balance. Test tip: be prepared to compare reverse mortgages to HELOCs on the exam. Key difference: reverse mortgages do not require monthly payments, while HELOCs do. Both use home equity, but repayment timing and eligibility requirements are very different. Next up, interest-only loans. Part 3. Interest-only loans. An interest-only loan allows a borrower to pay only the interest for a specific period, typically the first 5 to 10 years of the loan. After that period, the borrower must start paying both principal and interest. Key features of interest-only loans. 1. Interest-only period. During the interest-only period, the borrower only pays interest on the loan balance. The principal balance remains unchanged during this time. 2. Principal payments begin after the interest-only period. After the interest-only period ends, the borrower must start making full principal and interest payments. This leads to much higher monthly payments, often resulting in payment shock. Why borrowers choose interest-only loans? They want lower monthly payments during the interest-only period. They expect their income to increase before principal payments are required. They are investors looking for short-term financing for properties they plan to sell or refinance before the interest-only period ends. Pros of interest-only loans: lower monthly payments during the interest-only period. Can be useful for investors or borrowers expecting a significant increase in income. Cons of interest-only loans: payment shock. Once the interest-only period ends, the borrower's payment increases significantly. No equity buildup. During the interest-only period, the borrower does not reduce the loan balance. Higher risk of default. If the borrower isn't prepared for the payment increase, they may struggle to make the higher payments and risk foreclosure. Next up, balloon mortgages and HELOCs. Let's start this section with balloon mortgages, a loan product that can be beneficial for borrowers with short-term needs, but comes with serious risks if the borrower isn't prepared to handle the final payment. What is a balloon mortgage? A balloon mortgage is a loan that has smaller payments during the term, followed by a large lump sum payment at the end of the loan. This lump sum is referred to as the balloon payment and is typically much larger than the borrower's regular monthly payments. Here's how it works. During the loan term, the borrower makes interest-only payments or small payments toward the principal. When the loan term ends, the borrower must make a balloon payment to cover the remaining balance in full. Why would a borrower choose a balloon mortgage? Balloon mortgages are typically used by borrowers who expect to sell the property before the balloon payment is due, plan to refinance the loan before the final payment, want lower monthly payments during the initial loan term. Risks of balloon mortgages. The biggest risk is the balloon payment itself. If the borrower can't pay off the remaining balance when it's due, they could face foreclosure or be forced to sell the property. Other risks include: 1. Refinancing risk. The borrower may plan to refinance before the balloon payment is due, but if market conditions change or their financial situation worsens, refinancing may not be an option. 2. Foreclosure risk. If the borrower can't make the balloon payment and can't sell or refinance, they risk losing the property. Test tip. The exam may ask what happens if a borrower can't make the balloon payment. The correct answer is usually one of the following. The borrower refinances the loan. The borrower sells the property. The borrower risks foreclosure if neither option is possible. Part 5. Home Equity Line of Credit. Next, let's talk about home equity lines of credit, or HELOCs. These loans are often used by borrowers who want flexible access to funds over time. What is a HELOC? A HELOC is a revolving line of credit secured by the borrower's home equity. Think of it like a credit card backed by your home. The borrower can withdraw funds as needed during a set draw period and only pays interest on the amount they've used. How does a HELOC work? There are 2 phases to a HELOC. 1, draw period. During the draw period, the borrower can withdraw funds as needed, up to their credit limit. Monthly payments are typically interest only during this time. The draw period usually lasts 5 to 10 years. 2, repayment period. After the draw period ends, the loan enters the repayment period, during which the borrower must start making principal and interest payments. The repayment period usually lasts 10 to 20 years, and payments are much higher than during the draw period. Why would a borrower choose a HELOC? Borrowers typically choose HELOCs if they want flexible access to funds for home renovations, emergencies, or debt consolidation, prefer to pay interest only on the amount they borrow during the draw period, want lower upfront costs compared to a cash-out refinance. Risks of HELOCs. 1. Payment shock. When the loan enters the repayment period, the borrower's monthly payment increases significantly. This can cause payment shock if they aren't prepared for the higher payments. 2. Variable interest rates. Most HELOCs have variable interest rates, meaning the borrower's payments could increase over time if the index rate rises. 3. Foreclosure risk. Since a HELOC is secured by the home, failure to make payments could result in foreclosure. Comparison: reverse mortgage versus HELOC. To wrap up, let's do a quick spoken comparison between reverse mortgages and HELOCs, since the exam may ask about key differences between these 2 products. Let's compare. Reverse mortgage GCM, only available to borrowers aged 62 plus, no monthly payments required. The loan is repaid when the borrower sells, moves out, or passes away. Comes with higher upfront costs due to mortgage insurance premiums. HELOC, available to borrowers of any age, requires monthly payments once funds are drawn. Payments start with interest only during the draw period and then transition to principal and interest during the repayment period. Lower upfront costs compared to a reverse mortgage, but borrowers risk payment shock if rates increase. Recap of key differences. 1. Age requirement. Reverse mortgage, borrower must be 62 or older. HELOC, no age requirement. 2. Monthly payments. Reverse mortgage, no monthly payments required. HELOC, monthly payments required once funds are drawn. 3. Repayment timing. Reverse mortgage, repaid when the borrower sells, moves out, or passes away. Repaid during the repayment period after the draw period ends. 4. Risk of foreclosure. Both loans come with foreclosure risk if the borrower fails to pay property taxes, insurance, or home maintenance. Final thoughts for Part 5. It's critical to understand the key differences between non-traditional mortgage products and when they might be suitable for borrowers. Always consider the borrower's goals, financial situation, and risk tolerance when recommending a loan product. Coming up, deep dive recap and quiz. Let's get into some additional details on non-traditional mortgage products that you might not have caught earlier. These points are critical for the exam and will help you feel confident in answering even the trickiest questions. 1. Key ARM regulations and rules. The TILA-RESPA Integrated Disclosure TRID rule applies to ARMs, meaning that lenders must provide borrowers with detailed disclosures about how their interest rate and payments may change over time. Important ARM disclosures. Loan estimate, LE. The lender must clearly disclose the initial interest rate, the maximum interest rate that can be reached, the maximum monthly payment possible during the loan term. Closing disclosures, CD. The lender must reconfirm all of the above in the final disclosure. Negative amortization rules. Remember, negative amortization occurs when a borrower's monthly payment is too low to cover the interest owed, causing the loan balance to grow instead of shrink. Here's what you need to know about negative amortization rules. 1. Prohibited for high-cost mortgages. HOPA, Home Ownership and Equity Protection Act, prohibits negative amortization for high-cost loans to protect borrowers from predatory lending practices. 2. Prohibited for qualified mortgages. Qualified mortgages, loans that meet specific underwriting standards, also cannot allow negative amortization. ARM rate adjustment timing. ARMs adjust according to a set schedule, and the timing of adjustments is important to understand. Initial adjustment. The first rate change happens after the initial fixed period, e.g., after 5 years for a 5/1 ARM. Subsequent adjustments. After the initial adjustment, rates change on a regular schedule, e.g., once a year for a 5/1 ARM. 4. HELOC risk factors. Variable rate and payment shock. Most HELOCs have variable interest rates, meaning the borrower's monthly payment can increase if the index rate rises. HELOC payment shock. During the draw period, borrowers make interest-only payments, which keeps payments low. When the repayment period begins, borrowers must start making principal and interest payments, which can cause payment shock. Part 7. Quiz. Let's test your knowledge. Ready to test what you've learned? Let's do a quick quiz to make sure you've got the key concepts down. Question 1. What are the two components used to calculate the interest rate on an ARM? A. Loan-to-value ratio and credit score. B. Index and margin. C. Payment cap and periodic cap. D. Lifetime rate cap and initial rate cap. B. Index and margin. The interest rate on an ARM is calculated by adding the index to the margin. The index is the variable rate that changes with the market, and the margin is a fixed percentage set by the lender. Question 2. Which of the following loan types requires no monthly payments and is available only to borrowers aged 62 or older? A. Interest-only loan. B. HELOC. C. Reverse mortgage. D. Balloon mortgage. C. Reverse mortgage. A reverse mortgage allows borrowers to access their home equity without making monthly payments. The loan is repaid when the borrower sells the home, moves out, or passes away. Question 3. What is the most significant risk associated with a balloon mortgage? A. Payment shock. B. Negative amortization. C. Balloon payment risk. D. Refinancing risk. Answer. Balloon payment risk. The balloon payment is a large lump sum payment due at the end of the loan term. If the borrower can't make the payment, they risk default and foreclosure. Question 4, true or false? A payment cap on an ARM limits how much the interest rate can change. Answer, false. A payment cap limits how much the monthly payment can increase but does not limit the interest rate itself. If the payment cap results in a payment that is too low to cover the interest, negative amortization can occur. Question 5. Which type of loan allows borrowers to withdraw funds as needed and make interest-only payments during the draw period? A. Reverse mortgage. B. Interest-only loan. C. HELOC. D. Balloon mortgage. C. HELOC. A HELOC, home equity line of credit, is a revolving line of credit secured by the borrower's home. Borrowers make interest-only payments during the draw period and principal and interest payments during the repayment period. Final thoughts for Episode 2. You've made it through Episode 2, Non-Traditional Mortgage Products. Here's a quick recap of the key takeaways. 1. ARMs, interest rate adjusts based on index and margin. Includes caps to limit changes, but risks include payment shock and negative amortization. 2. Reverse mortgages, available to borrowers age 62 plus with no monthly payments, but higher upfront costs and reduced equity over time. 3. Interest-only loans, lower payments during the interest-only period, followed by higher payments once principal payments begin. 4. Balloon mortgages, small payments during the term with a large lump sum payment at the end. 5. HELOCs, revolving line of credit with interest-only payments during the draw period and principal payments during the repayment period. Coming up next, Episode 3, Mortgage Loan Origination Activities. In Episode 3, we'll cover completing loan applications, calculating DTI and LTV ratios, analyzing credit reports, pre-qualification versus pre-approval. So stick around, you're doing great. Happy studying, and remember, you've got this.